Two people earn the exact same income this year, same number on the paycheck, same job title roughly, same city, same cost of living. One of them pays 31% of that income in taxes. The other one pays 11%. Same income, same country, same tax code. And here's the part that will sit with you. Neither of them did anything illegal, not even close. One of them just knew things the other one didn't. Specifically, they knew how the tax system was actually written, not how it's commonly understood, but how it actually works when you read what's on the page. Because the tax code was not written to be equal, it was written over decades by legislators who were heavily influenced by people with accountants and lobbyists and long-term financial strategy. And buried inside that code, in the sections most people never reach because they stop at their W-2, are legitimate legal structures that quietly allow wealth to grow in ways that the standard paycheck-to-paycheck tax experience never touches. This is not a conspiracy. It's not a loophole in the shady sense of the word. It's just architecture. And most people were never shown the blueprint. Hi, my name is Alpha, and in this video, we're going to walk through exactly what that blueprint looks like. The tax strategies that wealthy people use routinely, that most working people have never been told exist, and that are far more accessible than the financial industry would have you believe. This isn't about dodging taxes or gaming the system. It's about understanding a system that was always available to you, just never explained. Here's the story most people grew up with about taxes. You earn money, the government takes its share, you keep the rest, and that's just how it works. The amount you owe is determined by how much you make. The more you earn, the more you pay. Fair enough. That's the basic idea of a progressive tax system. But that story is missing an enormous amount of context, because what the tax code actually taxes is not income in some pure, simple sense. It taxes specific types of income in very specific ways, and the way a salaried employee's income is taxed is fundamentally different from the way an investor's income is taxed. The way a business owner's income is taxed is fundamentally different from the way a freelancer's income is taxed. The rules are not the same for everyone, and that difference is not an accident. Most working people experience the tax system through one lens, the W-2. Money comes in, taxes come out, before you even see it. You file a return in the spring, and either get a small refund or owe a little more. The entire experience is passive. The system takes what it takes, and you work with what's left. Wealthy people, or more precisely, people with access to good financial and tax guidance, experience the tax system through a completely different lens. One where timing matters, where the structure of income matters, where what you do with money before it gets taxed can change the outcome dramatically. The gap between those two experiences is not primarily about income level. It's about knowledge, and that's worth sitting with for a moment, because it means the gap is actually closable, not all at once, not without effort, but more than most people believe. Let's get into how this actually works, because I want this to feel real, not theoretical. The first thing to understand is the difference between ordinary income and capital gains. This single distinction is responsible for more of the wealth gap in tax treatment than almost anything else. When you earn a salary, when you clock in, do the work, and get paid, that income is taxed as ordinary income. Depending on where you fall in the tax brackets, you could be paying anywhere from 22 to 37% in federal tax on that income, plus state taxes on top of that in most places. Now, when a wealthy investor earns money not through a paycheck but through the appreciation of an asset, a stock, a piece of real estate, a business, and they hold that asset for more than a year before selling, that profit is taxed at what's called the long-term capital gains rate. And that rate, for most people, is either 15 or 20% federally, significantly lower than what most salaried employees pay on their ordinary income. So the executive who earns $2 million a year in salary pays a very different effective tax rate than the investor who generates $2 million a year in capital gains from assets held over time. Same dollar amount, very different tax treatment. This is not a secret in any legal sense. It's written plainly in the tax code. It's just not something that comes up in the standard financial education most people receive. The second concept is something called tax-advantaged accounts. And this is where the gap between what most people use and what's actually available becomes genuinely striking. The most common version of this is the 401k, or the IRA, and most people have at least a vague awareness of these. But what often gets missed is the full scope of how powerful they actually are, not just as savings vehicles, but as tax reduction tools. When you contribute to a traditional 401k or traditional IRA, that money comes out of your taxable income before taxes are calculated. So if you earn $70,000 and contribute $7,000 to a traditional 401k, you're only paying income tax on $63,000. That's not a small thing. Depending on your bracket, that could be $1,500 to $2,000 less in taxes this year alone, money that stays in your account compounding, rather than going to taxes. The Roth version works differently, but is equally powerful in its own way. You contribute after-tax dollars, which means no deduction now, but the growth inside that account, and every dollar you eventually withdraw in retirement, is completely tax-free. Completely. If you're young and you have decades of compounding ahead of you, the Roth is one of the most powerful tax tools available to ordinary people. And yet the majority of people who have access to a Roth option through their employer either don't use it or don't max it. Beyond these, there are health savings accounts, HSAs, which are arguably the single most tax-efficient account structure available in the American tax code. Contributions are pre-tax. Growth inside the account is tax-free. Withdrawals for qualified medical expenses are tax-free. That's a triple tax advantage that exists nowhere else in the system. And yet the majority of people with access to an HSA use it only as a short-term medical expense fund rather than as the long-term investment vehicle it can be. Wealthy people and their advisors know these structures and use them intentionally, systematically, and at scale. The structures themselves are available to almost anyone. The difference is that most people were never told to take them seriously. The third concept is what tax professionals call tax loss harvesting. It sounds technical, but the underlying idea is simple. When you have investments in a taxable account, and some of them have decreased in value, you can sell those positions at a loss, lock in that loss on paper, and use it to offset gains elsewhere in your portfolio, or even to offset a portion of your ordinary income, up to $3,000 per year under current rules. The position you sold can be replaced with a similar investment after a short waiting period, maintaining your overall portfolio exposure. Wealthy investors with large portfolios do this deliberately and consistently. It's not about making bad investments. It's about being strategic with the timing of when gains and losses are recognized. For someone with a large, diversified investment portfolio, tax loss harvesting can save tens of thousands of dollars over a decade in taxes that would otherwise be owed. The fourth concept goes deeper and involves the structure of how income is generated in the first place. Business owners and self-employed individuals have access to a set of deductions and structures that salaried employees simply do not. A legitimate business expense, a home office, a vehicle used for business, health insurance premiums for the self-employed, retirement contributions made through a solo 401k, or SEP IRA, can reduce taxable income dramatically before the tax calculation even begins. A solo 401k, for example, allows a self-employed individual to contribute both as the employee and as the employer, which means the annual contribution limit can reach considerably higher than what a standard 401k allows. For a self-employed person in their 40s or 50s trying to catch up on retirement savings, this can be a substantial difference. None of this means you should start a business purely for tax purposes. That would be backward. But it does mean that if you are already self-employed, freelancing, or running a small business and you're not working with someone who understands these structures, you are very likely overpaying. The fifth and perhaps most philosophically interesting piece is something called the buy, borrow, die strategy. This is how the very wealthiest individuals, the ones with significant asset wealth rather than just high incomes, often avoid paying capital gains taxes on appreciated assets entirely during their lifetime. Here's the simplified version. You own an asset, a stock portfolio, a real estate holding, a business stake that has appreciated significantly over time. If you sell it, you trigger a taxable event. You owe capital gains tax on the profit. But if you don't sell it, if instead you use that asset as collateral to borrow money at a relatively low interest rate, you access the value of the asset without selling it. No sale means no taxable event. You live on the borrowed money. And when you eventually pass that asset on to your heirs, under current tax law, it receives what's called a stepped-up basis, meaning the cost basis resets to its current market value at the time of death, erasing the accumulated gain entirely. The tax on decades of appreciation can, under this structure, never be paid. This is not a rumor or a conspiracy theory. It is a documented feature of the current tax code, used openly by ultra-high net worth individuals and discussed plainly in estate planning literature. It is not accessible to everyone in its full form, but understanding it matters because it illustrates something fundamental about how the tax system treats passive wealth differently from earned income, and why the structure of how you accumulate and hold wealth has long-term tax implications that go far beyond your annual return. Here's the realization that I want you to take from all of this. The tax code is not neutral. It was written by humans, shaped by interests, and structured in ways that reward specific behaviors: holding assets long-term, using tax-advantaged accounts, generating income through investment rather than labor, owning a business. These are the behaviors the code incentivizes. Knowingly or not, the people who do these things pay less in taxes. The people who don't pay more. This is not a reason for bitterness. It's a reason for a very specific kind of decision-making shift. Because most of those incentivized behaviors are not exclusive to the wealthy, they're available, in scaled-down, highly practical forms, to people at almost every income level. The mindset shift is this: taxes are not a fixed bill that arrives at the end of the year. They are a calculation that can be influenced by the decisions you make throughout the year and throughout your financial life. The earlier you start thinking about taxes as a planning problem rather than a filing problem, the more of your money stays yours. So where does this actually start for a real person living a real life? It starts with whatever tax-advantaged space you have access to and aren't fully using. If your employer offers a 401k with any kind of match, that match is the highest guaranteed return available to you, and not capturing it fully is one of the most costly financial mistakes you can make. If you have access to an HSA through a high-deductible health plan, consider using it not just for current medical expenses, but as a long-term investment vehicle. Invest the balance, let it grow, and preserve it for healthcare costs in retirement, when that tax-free withdrawal will be most valuable. If you're self-employed or doing any kind of freelance work, speak with a tax professional who specializes in small business, not just a general tax preparer. The difference in what they find can be significant. The cost of good tax guidance is almost always offset many times over by what it saves. If you have a taxable investment account, start paying attention to the difference between short-term and long-term holdings. Holding an investment for more than a year before selling, when it's practical to do so, moves your gains from ordinary income tax rates to capital gains rates. That's a meaningful difference that costs nothing except a little patience. And if you're years away from retirement and still figuring out whether to use traditional or Roth tax treatment for your retirement accounts, the general thinking is this: if you expect your tax rate to be higher in retirement than it is now, Roth tends to win. If you expect it to be lower, traditional tends to win. If you're genuinely not sure, which is most people, splitting contributions between both gives you flexibility to manage taxable income in retirement, depending on what the rules and your situation look like at that time. None of this requires being wealthy, it requires being intentional. And intentionality, once you start applying it, tends to compound in the same quiet, reliable way that money does. There's something that doesn't get said often enough in financial content, and I want to say it here clearly. The fact that most people don't know these things is not a personal failure. The tax system is genuinely complex. It was not designed to be easily understood by someone without a team of advisors. The people who benefit most from it have spent real money and real time making sure they understand it. And for a long time, that knowledge felt like it belonged to a different world than most of us live in. But it doesn't have to stay that way. Not entirely. Not for you. You don't need to become a tax expert. You don't need to restructure your entire financial life overnight. You just need to start asking slightly different questions. Not how much do I owe, but how can I legitimately reduce what I owe? Not what accounts do I have, but am I using the accounts available to me in the most efficient way possible? Those questions, asked consistently over years, add up to something real. Thousands of dollars that stay in your account instead of leaving it. Retirement savings that grow in tax-protected space rather than taxable space. A financial life that works slightly more in your favor, not because you found a loophole, but because you learned the rules. The wealthy have known these things for a long time. Now you do too. And that's a more powerful starting point than most people give themselves credit for. Start where you are, use what's available, and keep going. And if this video gave you something useful, if it shifted even one thing in how you think about taxes and money, please don't forget to like this video and subscribe to the channel. It genuinely helps more people find content like this. And that's exactly why we keep making it.